Welcome to Silver&Metal IQ. This is Peter, and today I'm going to tell you something that could save you from a mistake you may regret for years. Because right now, silver is doing something dangerous. It's making your brain feel safe. It's climbing fast, flashing profits, and whispering that familiar thought, "I'll just take the win at $100." That feeling is not discipline. It's a psychological trap. A round number feels like a finish line. But markets don't care about round numbers. They care about mechanics, supply, demand, and the moment when the shorts get forced to cover. And that's the real question. Is the squeeze already happening, or is it still building? If you sell at $100 just because it's a clean checkpoint, you may be selling at the bottom of the launch sequence. The engine is still building pressure, and the real explosion may not even have started. Today, I'm going to explain why $100 is a trap, not a target, and how a true short squeeze unfolds in the real world. But before we dive in, quick favor. If you value this kind of breakdown, hit subscribe and comment OG, so I know you're part of the real Silver&Metal IQ community. Now let's jump in. The first thing you need to understand is that a short squeeze is not just a price rise. A squeeze is a forced buying event where traders who sold something they didn't own are forced to buy it back at any price available. That's not hype. That's a mechanism. Margin calls, risk limits, collateral demands, all of these force the shorts into a corner. So the real question is not whether silver can hit $100. The real question is, are the shorts being forced to buy yet? If they aren't, then $100 is early, and early can be expensive. Now here's the data point that should make you stop and think. As of January 13th, 2026, the commercial traders on COMEX are net short around 565 million ounces of silver. Meanwhile, registered deliverable silver is only about 47 million ounces. That's roughly a 12.1 mismatch. So for every ounce that can be delivered, there are 12 ounces promised in paper form. And the shorts are not shrinking, they're growing. That's not a sign of a squeeze ending, it's a sign of pressure building. Moving forward, we will break down what a real squeeze looks like using the Volkswagen 2008 and GameStop 2021 case studies, and why $100 could be the middle of the hallway, not the finish line. So today, let's break down the real meaning of a short squeeze, and why the current silver market is built for one. First, a quick reminder. The big money in this market doesn't care about headlines. Sovereign wealth funds, governments, industrial giants like Tesla and Samsung, they don't trade on margin. They don't chase charts. They buy physical metal because they need it, and because they understand that the world is entering a structural shortage. Now let's get to the key concept. Paper versus physical. In the paper market, you can sell what you don't own. You can sell contracts, promises, derivatives, and hope that the physical metal is available later. That's the whole system. And it works until it doesn't, because now the system is colliding with physical reality. When the market is tight, it becomes backwardated, meaning buyers pay more for metal today than for delivery in the future. That's not normal. That's a warning sign. And the most important point, backwardation destroys the advantage of short sellers. Why? Because if you're short, you have to deliver the metal when it's demanded. When delivery becomes expensive or scarce, your position becomes a ticking time bomb. This is where the squeeze starts, not with a trend or a chart pattern. It starts when shorts are forced to buy physical metal to cover. And right now, the physical market is screaming. Because it's not just retail demand. It's sovereign and industrial demand. When governments and industries compete for the same metal, price becomes secondary. They don't care if silver is $80 or $120. They need it. And when supply shrinks year after year, that demand becomes urgent. That's why we see big buyers standing for delivery, not trading on margin, not speculating, but buying actual metal. And that's the key difference between 2011 and today. In 2011, the spike was driven by leverage and speculation. Traders borrowed money to buy paper silver, driving prices up. When margins were raised, those traders got crushed and the rally collapsed. But today, the big buyers are not traders. They are long-term holders with real needs. and they don't care about margin requirements. So if you're waiting for a squeeze to be confirmed by price alone, you're missing the real signal. The signal is delivery, lease rates, backwardation, and physical stress. And right now, those signals are flashing red. Moving forward, we will compare real squeezes from history, like Volkswagen in 2008 and GameStop in 2021, to show you what a true forced short covering event looks like. A true short squeeze is not a gradual climb. It's a violent correction in the market's narrative, the moment when the smart money realizes they've bet against reality. The textbook examples are Volkswagen in 2008 and GameStop in 2021. Both cases share the same mechanics: a massive short position, limited supply, and forced buying that turns into a stampede. In VW's case, the market was flooded with short positions, and then Porsche revealed it controlled most of the free float. Suddenly, there wasn't enough stock available to cover the shorts. The result was a historic spike as shorts scrambled to buy whatever shares they could find at any price. That's the anatomy of a squeeze. It's not the price that causes the squeeze, it's the shortage. Now let's translate that into silver. Silver is not a stock, but the structure is similar. The COMEX market is a paper system where traders can short silver without owning it. The system works until physical demand exceeds the available supply, and that's when the market breaks. The shorts aren't just losing money, they're losing the ability to deliver. That's why they're willing to pay huge premiums for immediate delivery. That's why lease rates spike. That's why backwardation occurs. When physical metal becomes scarce, the market doesn't correct gently, it erupts. GameStop showed us another modern version of the same principle. Retail traders recognized that hedge funds were heavily shorting a limited float, and they forced the short sellers into a corner. The squeeze didn't happen because the stock was good. It happened because there was a structural mismatch between supply and the amount of paper being sold short. The short sellers had to cover, and covering means buying, which pushes the price higher, which forces more covering, and so on. It becomes a chain reaction. This is the same dynamic that is now appearing in silver, but with one major difference. The buyers are not retail traders. They are sovereign entities, industrial giants, and long-term holders. They are not driven by fear of missing out. They are driven by necessity. They need silver for manufacturing, AI infrastructure, solar panels, defense systems, and more. Meanwhile, mine supply has declined for 6 years straight. That creates a structural deficit, not a temporary speculative spike. So when the paper price drops, the physical demand doesn't relax. In fact, it accelerates. The market is not correcting, it's revealing the shortage. This is why the large deliveries and high lease rates are so important, because they show that the physical market is being drained, regardless of what the paper price does. When banks like TD short silver in this environment, it doesn't show confidence. It shows desperation. And that desperation is the first step toward a real squeeze. Not a meme stock style pump, not a hype-driven rally, a forced event where the market is compelled to reconcile paper promises with physical reality. Moving forward, we will break down what the current silver market is doing right now, why paper price drops no longer ease physical pressure, and why the top is in narrative is missing the real signals. Now here's the part most people don't understand. Paper silver and physical silver are not the same market. They move together most of the time, but when stress hits, they can split completely. The paper market is a system of contracts, futures, ETFs, and derivatives. It's designed for speed and leverage. You can buy and sell silver on a screen in seconds without ever touching a single ounce. The physical market is the real world, where metal has weight, shipping time, storage, insurance, and actual availability. When the supply chain is tight, the physical market does not care what the paper price says. It cares only about whether the metal is deliverable and in stock. Here's the dangerous truth. Paper silver can crash while physical premiums explode. This happens because the paper market is often dominated by big banks and hedge funds that can push prices with leverage. They can sell short, create synthetic positions, and move the price down even when physical demand is rising. But physical demand doesn't disappear just because the chart drops. In fact, it can grow stronger because the drop creates panic in buyers who realize the market is being manipulated. When that happens, physical premiums jump, and that's where the real warning sign appears. Imagine this. The spot price drops 5% in a week, and everyone thinks the market is safe again. But the dealer you rely on has less inventory than yesterday, and premiums have gone up. You try to buy, but the seller tells you, "We're out next shipment in 4 weeks." That's when the market is telling you the truth, not the chart. Because paper can be created instantly, but physical cannot. This is the same reason why physical silver often leads the paper market in real crises. The moment physical becomes tight, the premiums rise first. Paper follows later, if it follows at all. And when the squeeze becomes severe, the paper market may continue to show normal prices, while physical buyers are paying far above spot. That disconnect is not a conspiracy theory. It's a structural reality of the market. So why does this happen? Because the paper market is driven by liquidity and margin. It is fueled by credit. When a crisis hits, the banks can temporarily increase leverage, but they cannot magically produce metal. Physical metal must be mined, refined, transported, and stored. That takes time and cost. And when costs rise, the premiums rise, sometimes far more than the spot price. This is the trap. Many people think that if the spot price is low, it means it's safe to buy later. But if physical supply is tight, the spot price becomes meaningless. You can watch it drop and drop, while the actual cost to buy metal rises. That is the moment when the market stops being a game of charts and becomes a game of logistics. And that's why the 10% tariff deadline matters. Because even a small disruption in the supply chain can cause a physical shortage while the paper market stays calm. The paper market can pretend everything is normal, but the physical market will tell you the truth through premiums, shipping delays, and empty shelves. Moving forward, we will discuss the real reasons behind rising premiums and why industrial demand is the silent force that can push silver into a squeeze faster than retail buyers ever could. Now we need to talk about the part of silver that nobody wants to admit because it's boring, but it's the real engine behind the move. Silver is not only an investment metal, it's a critical industrial metal. It is used in solar panels, electronics, medical devices, batteries, and high-tech manufacturing. And unlike gold, which is mainly a store of value, silver has a huge real-world demand that does not disappear when the price rises. In fact, when prices rise, industrial buyers often panic buy to secure supply. That creates a feedback loop that can explode into a full-blown squeeze. Here's the core idea. Industrial demand is not optional. A factory cannot stop needing silver overnight just because the price goes up. They can try to substitute, but substitution takes time, research, and cost. This means that when physical supply tightens, industrial demand becomes even more aggressive, not less. And when industrial demand joins retail demand in the same market, the physical supply gets pulled faster than anyone expects. That is when the squeeze becomes real. Now add the short position into this equation. The short sellers in silver don't own metal. They are betting that the price will go down. But they don't just need the price to go down, they need supply to stay available. Because if physical demand increases and supply stays tight, the shorts are forced to buy back. This is the mechanism of a short squeeze. The key point is this. Short squeezes are not driven by price. They are driven by supply stress. Let me explain with a simple example. Imagine the paper market has a massive short position and the physical market has tight supply. If the shorts need to close, they must buy metal in a market where supply is limited. That drives prices up, which forces more shorts to cover, which drives prices up more. And the cycle repeats. That's the squeeze spiral. And this is why you see physical premiums rising, even when the paper market looks normal. Because the real buying pressure is happening in the physical market, where the shorts cannot hide. Another major factor is the delivery risk. When the market becomes stressed, the futures market becomes unreliable. If the shorts believe they cannot obtain physical metal, they may attempt to cash settle. But cash settlement is not a solution. Cash settlement is an admission that the system cannot deliver the physical commodity. Once that becomes obvious, confidence collapses, and the physical market becomes even tighter. The price can skyrocket, while the paper market loses credibility. So what does this mean for you? It means the biggest danger is not, when will silver hit $100? The biggest danger is when the physical market starts telling the truth, and the paper market has to follow. And when that happens, the move is not gradual. It is explosive. It is fast. It is chaotic. It is exactly what a short squeeze looks like. And here's the most important point. The shorts don't have to lose control instantly. They can hold the market down for a long time with leverage and rules, but they cannot hold it forever. Because physical demand continues, and supply cannot be created instantly. Eventually, the system becomes unstable, and when instability becomes visible, the market breaks. That's why you need to pay attention to physical premiums, delivery delays, and inventory changes, not just the spot price. Because those are the signals that the squeeze is real, not just a rumor. And when the squeeze becomes real, $100 will not be a destination. It will be a stepping stone, a launch pad, a warning sign that the real move is just getting started. Moving forward, we will summarize everything clearly, give you the key signals to watch, and finish with the financial disclaimer that protects you from the risk of misunderstanding this as advice. All right, this is the part where we put everything together in one clean picture so you can actually make sense of what's happening. Silver is not moving because of hype. It's moving because the system is showing stress. The commercial shorts are still huge. The registered inventory is not growing. Physical premiums are rising. The paper market is trying to keep the narrative under control, but the physical market is telling the truth. Metal is tight. That combination is exactly what creates a short squeeze. And if you sell just because $100 feels like a round number, you may be selling right in the middle of the launch sequence. The history of squeezes like Volkswagen and GameStop shows us one thing clearly. The real explosion happens after the first big move, not before it. In those cases, the market realized the shorts were trapped before the vertical spike. And if the same pattern plays out in silver, $100 won't be the end. It will be the start of the real squeeze. Now, what should you watch for? First, watch commercial net short position. If it starts collapsing while the price is rising, that's a clear sign covering has begun. Second, watch open interest. If it falls while the price climbs, it means positions are being closed, not rolled. Third, watch registered inventory. If registered inventory drops while paper claims remain huge, that's the squeeze battleground getting tighter. Fourth, watch physical premiums and delivery delays. When premiums widen dramatically and delivery becomes difficult, the physical market is screaming. And finally, watch exchange rule changes. Margin hikes and cash settlement incentives don't solve scarcity. They only buy time. So if the exchange keeps tightening the rules, that's a sign the system is under stress. Now let's be clear, this is not financial advice. I'm not telling you to buy, hold, or sell. I don't know your risk tolerance, your financial situation, or your investment goals. The market is unpredictable and volatile, especially in a squeeze environment. Silver can move up or down quickly, and leveraged positions can be liquidated even if the long-term thesis is correct. Always do your own research, consult a licensed financial professional, and never invest money you cannot afford to lose. If you are trading, use proper risk management and position sizing. If you are holding physical metal, make sure you understand storage and counterparty risk. And if you're unsure, it's better to step back and learn more than to act on emotion. Before you go, I want to remind you to stay sharp, stay patient, and stay disciplined. The biggest money in squeezes is made by the people who plan ahead, not the people who panic when the move happens. So if you found this breakdown valuable, hit subscribe and join the community. Drop a comment below with your plan if silver hits $100, and what signal would convince you the real squeeze has started. Thanks for watching, and I'll see you in the next video.